Hello, welcome back to corporate finance class, and this is the sixth module. We'll be talking about dividend policy and corporate valuation. Dividend policy and corporate valuation. And in this module, we will look into dividend policy theory. We will also look into corporate valuation models, and we will look at shareholders' wealth maximization. Each of these is what we will look into, and this is just a brief discussion on this topic. We have the notes available, and you can just opt in for that. Now, looking at the topic, we have key concepts, which is dividend policy, and we also have the corporate valuation. And what is dividend policy? It actually refers to the decision a firm makes about how much of its earnings should be distributed to shareholders as dividend and how much should be retained for reinvestment. It is the decision of a firm to make about how much of its earnings that is to be distributed to the shareholders as a dividend, and that which is supposed to be retained, which is retained earnings as for the investment. And for corporate valuation, it's the process of determining the economic value of a company, and it helps analysts, investors, and managers to be able to understand a firm's true worth. And both concepts are central to the primary objective of corporate finance, which is maximizing shareholders' wealth. Theories of dividend policy. We'll be talking about the relevance theory and the irrelevant theory. For the relevant theory, it argues that dividend policy is relevant and impacts a firm's value. It says dividend policy is relevant and impacts a firm's value. And proponents believe that investors prefer current dividend over future capital gain. And key models under this is the Waters model and Gordon's model. And under the irrelevant theory, it argues that dividend policy is irrelevant in a perfect market and does not affect a firm's value. And this is based on the idea that investors are indifferent between dividends and capital gain. And a key proponent or model for this theory is the M&M model or theory. As such, we will look into it. For the relevance theory, we talked about water model. We will discuss on this only. And the first I will like to tell us is what it says. The Waters model states that firms should retain all earnings when their internal rate of return is greater than the cost of capital, as this creates value. And they should also pay out dividend when R is less than the cost of capital as such. And what is the core idea? It's the dividend decision signal to the market whether a firm has profitable investment opportunity. And looking at the irrelevance theory under the M&M theory, this theory is based on several assumptions, including no taxes, no transaction cost, and perfect capital markets. And under this condition, the total value of the firm is determined by its earning power and its investment decision, not by how it distributes its earnings, like that of the Waters model that we talked about. And the theory suggests that what an investor gains from dividend is offset by a decrease in the firm's stock price. And a practical consideration into the dividend policy. In the real world, dividend policy is highly relevant due to market imperfection. And the reason for paying dividend include one, for investors' preference. That is, some investors like retirees prefer a steady stream of income. Also, another reason is information asymmetry, and this is dividend can signal a firm's financial health and future prospects. And the last reason is agency cost, and this talks about regular dividend can reduce the risk of managers misusing free cash flow. Now, going to the concept of corporate valuation. Why is valuation important? We've talked that it helps to be able to know the value of or the worth of such an organization at that moment. Now, why is valuation important? The first is for investment decision, that is to determine if a stock is overvalued or undervalued, and also for merger and acquisition. And this talks about to set a fair price for a target company. Another is for performance management, and this is to assess whether management is creating value. And lastly, as to why valuation is important, is for capital budgeting. That is to understand how individuals project contributions to the firm's overall value. We have methods of valuation, and the first is the discounted cash flow model. We have the comparable company analysis, and we have the precedent transaction analysis. For the DCF model, it's the most theoretical sound method, and it determines a company's value based on the present value of its future cash flow. And for the comparable company analysis, it talks about the valuation, that valuation are derived from the market's value of similar publicly traded company. And for the precedent transaction analysis, meaning valuation method, it shows that the value is based on the price paid for similar companies in recent merger and acquisition transactions as such. Looking at the discounted cash flow, we have processes or steps that can be followed. Step one is to forecast the company's free cash flow for a specific period, maybe between 5 to 10 years. And then two is to estimate a terminal value to represent all cash flow beyond the cash forecast period. And the third step is to use a discounted rate, usually the work to find the present value of the forecasted cash flow and the terminal value. And the limitation of the discounted cash flow is that it's highly sensitive to the assumption made about future growth rates and the discount rate. In conclusion, dividend policy and corporate valuation are two sides of same coin, and they both aim to maximize shareholders' wealth. While theories of dividend policy offer different perspectives in practice, the firm choices signals its financial health and strategic direction. Corporate valuation provides the tool to be able to measure the success of these decisions and to understand a company's true worth. Thank you.